All right, good afternoon, everyone, and welcome to this webinar presented by YL Capital. My name is Joseph Wong, and I'm the Chief Investment Officer here at YL. This webinar is a review of what happened in March, all the global events, the economy, and what happened in the financial markets. So here's a quick rundown of what I'm going to cover, an agenda, if you will. First, an executive summary. Second, recent geopolitical developments in the Middle East. I'm sure many of you know there's a major conflict going on in that region involving the US, Israel, and Iran. Third, the economy. Is it going along well? Is it strong or is it weakening? Fourth, what's happened in the financial markets? Stocks, bonds, currencies, gold. We'll take a look at that as well. And then finally, looking ahead, what's ahead in the future? What's next? So I've got a few thoughts there. So an executive summary. The major headline consuming the news and the markets is the war in Iran, which started on the last day of February this year and has continued through the month of March. During March, oil prices rose by about 50%, which is pretty significant. That move coincided with growing concerns that higher energy costs could push inflation higher again after a period where central banks had worked hard to bring inflation back towards their targets of around 2%. These central banks have cut rates several times, interest rates. But a rise in inflation could delay or put any future rate cuts in jeopardy. Consequently, US equities have fallen and seen increased volatility due to all the uncertainty surrounding not only the war, but also the price of oil, inflation, as well as interest rate policy. Geopolitical developments. Okay, here's what's transpired in the war in Iran so far. This slide is a high-level summary of how the conflict has evolved through March, based on publicly available news reports as of March 31st. Broadly speaking, tensions escalated sharply towards the end of February, with reports of significant military actions involving Iran and a US-led coalition. Over the month, there were multiple episodes of intensified fighting, statements from varying governments, and intermittent reports of potential diplomatic efforts. Rather than focus on each individual headline, the key points for markets has been the ongoing uncertainty over the scale and the duration of the conflict, and what that could mean for oil, energy supply routes, stability in the region, as well as investor sentiment. Now, the details on this slide are meant to illustrate that the situation has been fluid and pretty fast moving, not necessarily to provide an exhaustive or definitive account of events. Now, soon after the conflict began, the Strait of Hormuz was effectively closed to shipping, with Iran controlling who can pass through the strait. Why is the Strait of Hormuz of such strategic importance? So let's take a look at this map here on the left, courtesy of the BBC. The strait itself is that circle on the southern coast of Iran. It's a narrow body of water, only about 39 kilometers wide at its narrowest point. But as you can see, it's surrounded by several large oil-producing countries, not only Iran, but Iraq, Saudi Arabia, Qatar, and the UAE, or United Arab Emirates, which includes the major cities of Abu Dhabi and Dubai. Now, about 20% of the world's oil, as well as 20% of the world's LNG or liquefied natural gas are transported through this strait. So when Iran effectively closes the strait by firing on ships that are passing through or planting mines, then the world's oil supply is constrained. Which leads to this next slide, showing the price of oil since December of 2024. Now, this is specifically for West Texas crude, but we see a similar price action for Brent crude oil as well. Now, I'll go back to the end of 2024 because the price of oil throughout 2025 and just before the war was relatively stable, as you can see. It has traded in a range of between $60 to $80 through these 14 months, just before the war. I show 3 key dates on this chart. One, December 31st, 2024, first day, where the price was $71.25. Then February 27th, 2026, just one day before the war started, the price was $67.02. Then the final date of this period, March 31st, 2026, where the price of oil had risen to over $101. And that represents a 50% increase in the price of oil in just 1 month. And this has had a significant impact on the price of gasoline. The fuel that we use to fill up our cars or automobiles or trucks, etc. In the US, because cars and driving are such a big part of the culture and everyday life, the price of gas is a common topic for discussion. Now, this colorful chart comes from AAA, the Automobile Association, and it shows the national average price of gas at the pump as of the end of March. That's that big red circle on the left. It shows the price was just a little over $4, $4.02, let's take it. Now, the price of gas does vary depending on which state you are in. For example, gas is typically more expensive in the western states. That's that red block in the west there. But the main point here is that the price of gas at the end of February was around $2.90 or so, $2.98, I think. That is below $3, right? So $3, less than $3 a month ago, just before the war. Now, in 1 month, that average gas price has jumped by more than $1, or more than 30% in percentage terms. So that's a big jump. So this is going to hit the bottom line of not only those industries and businesses that rely on oil, such as airlines, transportation companies, but also the regular person who drives a car or a truck. This is going to hurt their pockets. So we've set up the backdrop, right? The conflict in the Middle East, what the impact has been on the price of oil, and how it's flowing through to the general economy through the price of gas, for example. Let's turn to the state of the economy. We'll look at the US, since it's the largest economy in the world and tends to influence the other economies. This chart shows the real GDP, or gross domestic product, which is a measure of a country's aggregate economic activity. Now, this chart shows the last 6 quarters of economic growth, annualized. So annualized numbers here. The second and third quarters of 2025, those 2 tall columns on the right-hand side of the chart, showed pretty solid growth for the US, around 3.5% to over 4%. But the fourth quarter, Q4, that last column, for which we only currently have estimates, it shows a much weaker number. So based on that last reading, that Q4 reading from 2025, is the economy weakening? It's hard to tell with just one number, but let's take a look at some other economic data. So let's take a look at employment. This chart shows the monthly change in jobs numbers, measured in thousands. It's essentially a measure of jobs growth, right? So if there's an increase in jobs every month, that shows a relatively healthy economy. Now, I'll also show the annual totals, the total jobs added for each calendar year in the box to the right, in the right-hand section of the chart of the slide here. I'll go back to 2023. You can see that jobs growth was pretty strong in 2023, with over 2.5 million jobs in total added during the year. Now, 2023 was already a couple of years after COVID-related lockdowns were lifted, but perhaps there were still some remnants or sectors of the economy still catching up. If we look at 2024, jobs growth during the year was not as strong as 2023, but still added almost 1.5 million jobs, so still pretty healthy. 2025, however, was relatively weak. It showed a total of 116,000 jobs added during the year, which essentially shows pretty flat jobs growth for that year. Now, is that an indicator for where the economy is going? Again, it's just one data point when you think about it, but the trend is there, right? If you look at the monthly changes during 2025, there's a few ups and downs and relatively volatile period for jobs numbers. Now, we did have a nice bounce in January of 2026, but then February showed a drop again in just last month. Oh, well, in February, sorry. Last month was March, and its number actually dropped today, which showed a pretty healthy addition of about 178,000 jobs. So pretty volatile in terms of how jobs are being added month to month. Now let's move on to the unemployment rate. So we have monthly jobs numbers, how many were added each month. Now let's look at the unemployment rate. It's related to the level of employment. While jobs growth has been relatively flat over the past year, right, 2025, the unemployment rate, as you can see from this chart, is relatively stable. Now, there's a slight uptrend since the end of 2022, but it's hovered between 3.5% to 4.5%. It's currently at 4.4%. That's the latest number, which by historical standards is quite low. That number is for that 4.4% is for February, and the March number just dropped this morning. That's a 4.3. So no, it hasn't changed that pattern of between 3.5% to 4.5%. Relatively low unemployment. Now you see a gap there in the chart for October 2025. This is because there was no data released, and that was due to the US government shutdown during that period last year. So now let's move on to inflation. This is all important given the potential impact of the war in Iran that I've already mentioned, especially on oil prices, right? There's the immediate impact through gasoline prices, but also there's flow-through effects for the rest of the economy. Now, I'm using the US Consumer Price Index, or CPI. I'll go back to 2019 for this chart. So just before COVID arrived in North America. This is to show how high inflation reached post that peak COVID period in 2020, early 2021, and how far it's come down since then. So if we look at the start of this period in December 2019, the inflation rate was 2.3%. The Federal Reserve, which is the US central bank, would like to see inflation at around 2%. So 2.3% is above 2, but not by much. Now, during COVID, inflation did fall to almost zero, as you can see there in some of those early months of this chart, before rising quickly again during 2021 and 2022. In the wake of the economy reopening, right? Lockdowns were lifted, a lot of pent-up demand, and the economy exploded, and inflation rose pretty quickly. There was a lot of supply chain issues that fed into this rising inflation. Now, the high point of inflation was 9.1% annual change of 9.1% in the CPI, and this occurred during June of 2022. Then, due to a series of rate hikes from the central banks, it's come down quite steadily since then. to the point where it's at pre-pandemic levels for around 2.4% for February of 2026, just before the war in Iran started. So that 2.4% doesn't include any impact from the rise in oil prices that we've seen in March. Again, you see that gap in the data in October of 2025, again, due to the government shutdown for the US. So markets are eagerly looking for guidance from the March inflation numbers, they're due to be released in the next week or two. But if Europe is a guide, now Europe's also impacted by the price of oil, right? So if Europe is a guide, they've already released a preliminary estimate for March inflation. Not the final numbers, but it's an estimate for March. And it jumped from 1.9% annual change in February to 2.5% in March. Again, it's an estimate, but that size of increase is probably what's in store for the US as well. It's something they're probably going to expect to see, that 0.5% increase potentially in the CPI numbers. So let's move on to what's been happening in the markets. Now, we've talked about the geopolitical environment, what's been happening in the Middle East, how that has impacted the price of oil, and how that may be impacting the economy, even though we don't quite see it yet because we don't have March numbers. But let's move on to what's been happening in the markets. So US equities. This chart shows the price movement of US equities represented by the S&P 500 price index in US dollar terms. And it's since the end of 2024. I go back more than a year. This is a monthly review, but I go back more than a year since this is our first monthly review, and I want to give some context of where we came from, especially from 2025. And I put 3 key dates here. First date is December 31st, 2024, end of 2024. And the S&P 500 was at a price level of just under 5,900, as you can see there. It then fell during the early months of 2025 when President Trump started his second term, leading up to the so-called Liberation Day in early April. Now you can see that steep drop around March, April, leading to that Liberation Day. And that's when President Trump introduced tariffs on many countries. But it has since rebounded from that point around early April and has rallied quite strongly. The second key date is February 27th, 2026, end of February, one day before the war began. It was at near all-time highs, around 68, 78 or so. And then the war began and the S&P has fallen. You can see that drop at the end of the chart there for March. So that's the third key date, March 31st, end of last month. S&P 500 has fallen about 350 points during the month, and that represents about 5%, just over 5% for the month of March. That's US equities. Let's take a look at Canadian equities, see how it's done. Canadian equity market is represented by the S&P TSX Composite price index, and it's in Canadian dollar terms. Same 3 key dates. So at the end of 2024, the price level for the TSX Composite was just below 25,000, so 24,727 or so. Now, 14 months later, the second key date at the end of February of 2026, the Canadian equity index here, the TSX Composite, has risen very strongly to over 34,000. Since then, it has fallen about 1,600 points, which represents about 4.5% a drop since the end of February. So the end of March price level is about 32,768. So that represents a percentage change of about 4.5% down on the downside versus the end of February. So we've covered US and Canadian equities. Let's take a look at the rest of the world. And this is EAFE, which is essentially Europe, Asia Pacific equities, developed markets in those regions. EAFE is represented by the MSCI EAFE index, price index again, and it's in US dollar terms. This index also rose quite strongly during 2025, but has fallen over 340 points during the month of March 2026. And this is it is actually over 10%. So a 10% drop in value just for March alone this year. Now, because the returns are in US dollar terms, some of this negative performance could be due to currency movements depending on the country and region. But even given that, it is still a poor month for equity returns in this region. So to summarize the three regions that I covered, let's look at the actual numbers, equity returns over the month of March, 1 month, the first quarter of this year, 3 months, and then the last 12 months. So for these three regions, US in blue, Canada in that orange column, and EAFE, Europe, Asia Pacific countries in that green column. So March was a poor month for equities across the board, with both the US and Canada down around 5%, and EAFE, Europe, Asia Pacific, essentially down more than 10%, right? So that's a pretty big drop for that region. Now, over the last 3 months, Canada, the orange column, still reported a positive 3.3% return, while the US and EAFE were both down. US down almost 5%, and EAFE down about 2%. Finally, over the last 3 months, the last 12 months, which is the rightmost set of columns, all three regions did show strong positive returns, with Canada actually outshining the US, and EAFE with a pretty strong 31.5% return during the last 12 months. Let's move to bonds, fixed income. So we've covered equities. Now let's take a look at some other asset classes. And first is US bonds. Here's a chart showing the US 10-year Treasury bond yield since the end of 2024, December 31st, 2024. A bond yield moves in the opposite direction to a bond's price. So when the bond yields go down, bond prices go up, and vice versa. So there's an inverse relationship. I show the yield because that's how bonds are traded in the market. They use yields rather than prices, but there's that inverse relationship. When bonds, when yields go up, prices go down, vice versa. So looking at this chart, the 10-year Treasury bond yield has fallen since the end of 2024, when it was at about 4.6% yield. But the important observation here, when you look at the whole chart, is that during March, that last month, yields rose by 0.35%, so more than a third of 1%, which is pretty significant in the space of about a month. And this is an indicator, a potential indicator, that bond investors are likely fearful of a spike in inflation. We've talked about oil prices rising, right? And how it's impacted gasoline already. Markets are looking for March inflation numbers. And bond investors, they're probably expecting a spike in inflation. So why are yields going up when there's an expectation of a spike in inflation? Now, yields go up, bond prices go down, right? So when there's high inflation, that erodes the purchasing power of the coupon interest or income that you get paid from owning those bonds. So let's say you get paid $10 every 6 months from owning a bond. If inflation goes up, that $10 doesn't buy as much, right? So that high inflation erodes the purchasing power of the income you get from the bond. And so it's a negative sign for bonds. And that's why you see maybe bond investors selling their bonds, prices going down, and hence yields are rising. It's risen by 0.35% during the month of March. Now let's move on to the US dollar. Currencies, US dollar, the world's reserve currency. So this chart shows DXY, ticker DXY, which is a US dollar basket index. It's essentially showing the US dollar versus a basket of other major currencies. There's a weighting scheme to it, but essentially think of it as a weighted average of other currencies such as the euro, the British pound, Japanese yen, etc. If DXY, this index, goes up, the US dollar is strengthening. And when it goes down, then the US dollar is weakening. Since the end of 2024, the start point of this chart, the US dollar has come down and essentially weakened against these other currencies. But in March, DXY, this index, it has risen to almost 2.5%. Now, there are many different factors that can influence a currency's movements, including imports and exports, interest rate differentials between countries, some simple supply and demand, and even in speculation, right? There's market participants who like to speculate on the direction of currencies, just like other assets. But one way to read into this rise in the US dollar during March is its status as the world's reserve currency and US assets in general, typically perceived as a type of or a type of safe haven. Let's put it that way, a type of safe haven, because of the size of the US economy and how it dominates asset prices, etc. There's a perception that US assets tend to be safer. That's one reason we could point to for why US dollar is rising. More people are getting into US dollar assets. Now, with March being volatile and uncertain, right? The war was raging, oil prices rose 50%, etc. It's an uncertain environment, and that's why we are potentially seeing this US dollar strengthen during the month, because investors are moving towards a safe haven type asset. And finally, gold. I include gold here because it's had a very strong run over the past couple of years due to central bank buying and other factors. If you look at this chart, the price of gold at the end of 2024, the start of the chart, the price was just over $2,600. And then if you go to the second key date here, February 2026, the end of February 2026, the price was over $5,200. So it's essentially doubled in price in the space of 14 months. Pretty spectacular rise in price for gold. 100% return in that period. But since the start of the war, right, at the end of February, war started, some of the luster of gold has disappeared. And in 1 month, that price has fallen almost $570, which represents more than 10% drop in the value of gold. Now, why? Again, there are several reasons, but one may be that maybe the long-held perception of gold itself as a safe haven asset, an inflation hedge, etc., may be on shaky ground. At least that could be one prescribed reason for that drop. When the world and the economy and the markets became more volatile and uncertain during March, investors sold gold rather than actually buy, right? So they were looking to other assets as more of a safe haven position. So we've covered the geopolitical backdrop, the impact on the economy, and how markets have reacted, especially during the month of March. Let's look ahead. What's in store for the world, the economy, and markets? So looking ahead, there is still considerable uncertainty. The markets are very focused on developments in Iran and on any signals from policymakers that might point toward a de-escalation, alternatively further escalation. Um, the messaging from various parties involved has not always been consistent, which contributes to the persistent day-to-day volatility in both equities and oil prices and just the market environment in general. The most immediate data point that markets are watching for is March inflation. So this past month, what has inflation done? Because that will help clarify how much of the recent energy price shock is feeding through to the broader economy. Now, if inflation data comes in higher than expected, there's probably some expectation built in, like Europe, that preliminary estimate, about 0.5% increase in inflation. So maybe markets are already expecting that or pricing that in. But if it goes any higher than that, then central banks would have less room to cut rates. They're already going to be constrained if they see a 0.5% jump in inflation. But if it's higher than that expected 0.5% jump, then that could keep central bank policy basically unchanged for the rest of the year. Some countries were expecting 1 or 2 more rate cuts this year, but with higher inflation, that may be off the table. But if inflation stays relatively contained, that could support a more constructive outlook for the central bank and how it looks at interest rates. So that's looking ahead. Still a lot of uncertainty. We await March numbers. The war is still ongoing, leading to a lot of uncertainty. How prolonged it is, nobody knows. We'll wait and see. But thank you very much for joining this webinar. If you have any questions or would like to find out more about YL Capital, please go to our website, ylcapital.ca, and have a great weekend. Thank you very much.